All right, let's get right into it. Welcome to This Explainer, where we are taking raw market data and distilling it into your absolute ultimate playbook for gold this week. The market is flashing some truly massive signals right now. But the real question is, are you reading the actual story, or just the one they want you to see?
So let's dive into this huge trap playing out on the charts. It's like a classic standoff. On one side, you've got retail traders reacting to the most obvious patterns, just getting completely swept up in the immediate price action. But on the exact opposite side, we have smart money. And here's the thing, institutions aren't reacting. They're already positioning themselves for the real underlying move. They're setting up the whole board while everyone else is just playing the pieces.
For instance, gold just printed what looks like a textbook gorgeous bullish pin bar candle on the weekly chart. I mean, it looks incredibly inviting if you're a retail buyer, right? But our source data throws up a massive red flag here. It warns that this is exactly where most traders get trapped right before the next major move. We absolutely have to look beneath the surface to keep from getting caught on the wrong side of this market.
So, to make sure you're trading alongside the institutions, here's our roadmap for today. First, we'll break down the smart money trap. Second, we'll look at the macro forces driving gold. Third, we'll map out a multi-timeframe blueprint. And finally, we'll lay out the exact weekly trading plan.
Okay, starting off with Section 1, the smart money trap. Don't fall for the obvious signals. Let's unpack what a bullish pin bar trap actually is. Because institutions require massive, and I mean massive liquidity to fill their orders without causing slippage, they can't just click buy or sell like we do. They rely on perfectly engineered setups, like that bullish pin bar we just talked about, to literally lure in retail buyers. They absorb that retail liquidity and then reverse the market on them. They're essentially generating the counterparty volume they need, at your expense.
Moving right along to Section 2, macro forces driving gold. This is the triad shaping XAUUSD right now.
To really know where gold is heading, you have to understand the three fundamental pillars pulling the strings: US dollar dynamics, geopolitical risks, and institutional activity. And honestly, that first one, it's the absolute heavyweight in the room.
We're talking about the US dollar index, or the DXY. For about 12 months now, the dollar has been consolidating, and this 100 level is the ultimate critical resistance ceiling. The dollar has formed a bullish double bottom and is finding some seriously strong support right at its 20-day moving average. If the DXY breaks and actually closes above 100, wow, we are looking at a potential major bullish expansion up toward 110, or maybe even 114.6 over the longer term. And if that happens, it's going to apply immense, crushing downward pressure on gold.
But there is a counterbalance here. Geopolitics are providing a structural floor for gold. Right now, we're seeing fragile ceasefire negotiations involving the US, Israel, and Iran, along with those ongoing Russia-Ukraine peace talks. Because no concrete resolutions have been signed yet, institutions still view gold as a necessary strategic hedge. That underlying safe haven demand isn't just going to vanish overnight.
Now check out this specific number, 1033. This represents the tons of gold currently held by the SPDR Gold Trust. Why is that a big deal? Well, because they just dropped their reserves from 1035 down to 1033 tons. It's not a total liquidation, sure, but it's a glaring footprint. It proves that while gold is struggling below major resistance, the big players are quietly trimming their exposure. They're rotating capital. So their conviction in a massive gold rally, it's pretty limited right now.
All right, let's jump into Section 3, the multi-timeframe blueprint. This is where we translate all those macro forces into chart realities.
Looking at the market structure, you can literally see the friction playing out. The long-term monthly trend is still technically bullish, sitting above its 20-month moving average. But as soon as you step down into the daily and 4-hour timeframes, boom, you immediately see short-term downtrends, descending channels, and lower highs. It's a real tug of war.
Zooming out, the tension is obvious. On the monthly chart, we've had 3 consecutive bearish candles. That seriously bumps up the risk of a deeper correction. Meanwhile, on the weekly, gold is just trapped inside this massive consolidation triangle between 4,400 and 4,700. And listen, 4,400 is the ultimate line in the sand for buyers. If we get a weekly close below 4,400, the ascending trend line breaks and the door gets ripped wide open for a drop to 4,300, 4,200, and even 4,100.
Drop in down to the shorter time frames. The daily chart shows gold consolidating below the 20-day moving average, basically held hostage, just waiting for the DXY's next move.
And on the 4-hour, we actually saw a massive 2,000 pip recovery after a false breakdown below 4,400. But guess what? Price was aggressively rejected right at the 4680 resistance zone, printing a bearish pin bar. That tells us we need to brace for gold to revisit those lower support zones, 4,500, 4,450, and 4,400, before any real bullish recovery can even start.
Okay, bringing it all together in Section 4, the weekly trading plan. These are your exact execution zones for June 1st through the 5th.
If you're playing the bearish side, we're targeting high-probability institutional sell zones overhead. Zone 1 sits up high, in the 4630 to 4700 area. You'd look at a tight stop loss at 4702, with your first target down in the 4550 to 4600 region, and a secondary target stretching from 4500 all the way down to 4100. Now, if you want a slightly more aggressive entry, Zone 2 is at the nearest H4 resistance between 4570 and 4600, with a stop loss at 4602. Targets there step down into the 4450 to 4500 range, and then down to 4100 to 4400. The whole goal here is to just ride that institutional selling pressure downward.
On the flip side, what if you're a buyer? Well, despite all that bearish pressure, strong recovery rallies are absolutely possible, but only as long as the US dollar index stays capped below 100. Buy Zone 1 is a deep discount level way down at 4,100 to 4,255, with a stop loss set at 4,887, targeting a bounce to 4,270 to 4,300. Buy Zone 2 sits on the daily support and rising trend line between 4350 and 4455, with a stop at 4347, targeting 4470 to 4500. And Buy Zone 3 is your nearest H4 support around 4415 to 4450, again with a stop at 4347, targeting 4530 to 4560. These are the heavily discounted areas where we'd expect institutional buyers to step back in.
Before we wrap up, the source material emphasizes one absolutely vital rule for navigating this week. On a false breakout, wait for the retest before re-entering. Seriously, don't just jump at the first candle that breaks a line. Wait for the price to come back and actually prove the level. This is exactly how you manage your risk and stay totally immune to those retail traps we talked about at the start.
So, the board is officially set. We've decoded the macro drivers, we've mapped out the multi-time frame friction, and we've clearly defined the institutional execution zones. But as that DXY juggernaut builds momentum to test that critical 100 level, a breakout that could literally crush gold prices, the ultimate question remains. Are you going to react like a retail trader, or are you going to patiently position yourself like smart money? How will you execute when the market makes its decisive move this week?